Welcome back to The Explainer. Today, we are taking a seriously fascinating journey into the invisible mechanics of money. I mean, we use it every single day, we stress about it, we save it, but honestly, how often do we actually pause to understand its underlying architecture? We're going to completely rebuild your understanding of value today, and we're starting with a massive paradigm shift about where money actually comes from.
All right, let's jump right in by challenging that classic Econ 101 narrative. For centuries, going all the way back to Adam Smith, we've been taught a very specific story, right? We're told that early humans traded chickens for grain, and because finding someone who wanted exactly what you had was just way too inefficient, we invented coins to make trading easier. But what if I told you that people almost never actually traded chickens for grain? Did humans really invent money just to replace barter? Well, anthropologist David Graeber, building heavily on foundational works like Marcel Mauss's The Gift, completely flipped this script. He proved that the pure barter economy is essentially a myth. Just let that sink in for a second. Early, non-monetary societies didn't rely on spot trading physical items at all. Instead, they relied on intricate gift economies and these really complex credit systems long before a single coin ever existed.
Look at the stark contrast here. On one side, the communal, credit-based system relied heavily on social trust and delayed settlement, and we have extensive historical evidence for this. Think about the clay tablets found in Mesopotamian temple complexes from around 3000 BCE that acted as these ancient central accounting hubs. Now, on the other side, we have the barter system. Historical and ethnographic evidence shows that barter almost entirely occurred between complete strangers or even potential enemies, basically people who had absolutely zero foundational trust to begin with.
So, here is our roadmap for this explainer. We're going to debunk the myth of barter, trace the evolution of the gold standard to fiat, unpack fractional reserves, navigate our modern digital rails in UPI, and then finish up with global blockchain settlement. Let's get to it.
Section 1. The myth of barter, and how credit actually came first.
You see, money was literally born out of language and a verbal promise of debt. It didn't come out of the inefficiency of trading physical items. This is summarized just perfectly by anthropologist Caroline Humphrey, who said, "No example of a barter economy, pure and simple, has ever been described, let alone the emergence from it of money." That quote right there completely shatters the barter illusion. Money originally emerged simply as a unit of account. It was just a way to quantify that otherwise unquantifiable social obligation of, hey, I owe you one.
Now, I know what you're thinking. What about those early physical objects like shells or beads? Well, early circulating objects, like the ones used in the Kula trade of the Trobriand Islands, they weren't modern money. They were actually symbols of honor and markers of past circulation. Anthropologists categorize this as a three-stage evolution. It starts with gift exchange, moves to primitive money, and finally arrives at the system of selling and buying with modern money that we know today.
Moving right along to Section 2. Gold standards to fiat, or the evolution of form.
So, if money started as this invisible social ledger, why on earth did we start lugging around heavy coins and paper? Well, tracing the timeline, we see it was largely about statecraft, military expansion, and just the sheer need for portability. In the 7th century BCE, the very first standardized Lydian coins appeared, stamped with official seals. By the Middle Ages, goldsmiths started issuing paper receipts for deposited metals, creating representative paper money. Fast forward to 1944, and the Bretton Woods Agreement pegged world currencies to the US dollar, which was strictly backed by gold at $35 an ounce. But then, in 1971, the Nixon shock happened. President Nixon ended this convertibility, untethering money from physical commodities and birthing the modern fiat system. In this system, value is derived entirely from government decree and our collective public trust.
Section 3. Fractional reserves and creation, where money actually comes from.
Okay, in a fiat system where a dollar is basically just an unbacked accounting unit, you really got to ask, where does money actually come from today? A lot of people just assume the government prints it all. Mind-blowing fact, they absolutely don't. The vast majority of our modern money supply is actually created out of thin air by commercial banks. They do this through a process called fractional reserve banking. When a bank takes in your deposit, they are only required to hold a tiny fraction of it in reserve. They lend all the rest out. And that loan, it literally becomes brand new money in the economy. But obviously banks don't just give it to anyone. To survive and manage all that risk, they rigorously evaluate borrowers using the 5 C's of credit: character, capacity, capital, collateral, and conditions. By passing that test, you are essentially allowing the bank to safely speak new money into existence. Modern money is quite literally debt.
Which brings us to Section 4, Navigating Digital Payment Rails, the modern ledgers.
All right, now that we know what this modern money actually is, we need to understand how it moves. We're going to look specifically at India's highly advanced tiered digital payment landscape, which is governed by the RBI and NPCI. To clear up this whole alphabet soup of Indian payment rails, let's just compare them side by side. NAFC processes in hourly batches and has absolutely no minimum limit. RTGS, on the other hand, is for high-value transfers starting at 2 lakhs, and it settles in real time. Then you have IMPS, which was the very first to offer true 24/7 instant settlement for smaller amounts up to 5 lakhs. And of course, we have UPI, which is also instant, incredibly mobile-first, and generally capped around 1 to 2 lakhs depending on your bank.
Let's make this super practical. When exactly would you use each of these? Say you're making a 15 lakh property down payment. You're going to want RTGS for that. Real-time, high-value settlement so you have instant proof. But what if you have an 85,000 rupee medical emergency at 11 p.m.? You're definitely using IMPS for that. Running company payroll for 100 employees? NEFT is perfect for predictable batch processing without getting hit by massive fees. And here's a crucial update. In October 2024, the RBI mandated beneficiary name verification across both NEFT and RTGS. This unifies safety standards and prevents fraud, bringing those older systems perfectly in line with what we already expect from UPI.
Section 5, The Architecture of UPI, a truly stateless revolution.
We all probably think of UPI as just that handy app on our phones, right? But underneath, it is a revolutionary stateless routing engine. And the scale here is just staggering. UPI processes over 10 billion transactions every single month, almost always in under 5 seconds. It does this by replacing all those cumbersome bank account details with a simple virtual payment address, or VPA. The NPCI switch acts as this massive, brilliant orchestrator. It uses incredibly fast in-memory caches, like KeyDB, to map your VPA to your actual bank account in what computer scientists call O of 1 time complexity. Basically, that means the system is so insanely efficient that finding your specific account takes the exact same microscopic fraction of a second, whether there are 10 users online or a billion.
So how does a transaction actually flow? It uses something known as the Saga pattern. First up, there's authentication via device binding and your PIN. Then the stateless routing kicks in. But here is the absolute genius part. It completely separates the transaction into a debit leg from the sender's bank and a credit leg to the receiver's bank. It's essentially trading strict, immediate consistency for eventual consistency. Think of it like handing off a baton in a relay race. If the receiver drops it, the system automatically initiates a compensating transaction. The runner simply takes the baton back and reverses the debit. It's brilliant.
And the tech stack powering the whole shebang? It's incredibly diverse. Engineers call it polyglot persistence. It's a lot like a highly coordinated digital restaurant kitchen. Apache Cassandra acts as the high-speed fry cook, logging millions of transactions a second. Postgres is the meticulous manager keeping all the user profiles perfectly consistent. And Apache Kafka is out there calling out the orders to keep everything expertly choreographed. All of this is managed using Kubernetes auto-scaling, which is exactly how UPI maintains 99.99% availability even during those massive, unpredictable traffic spikes on major festival days.
Finally, Section 6, Global Settlement and Blockchain, the future of the ledger.
Okay, so domestic systems like UPI and IMPS are absolutely incredible, but they are strictly domestic. So, how does money move across international borders? Looking impartially at the global landscape right now, we basically see two very different approaches. On one side, we have the legacy SWIFT system. SWIFT is essentially a messaging network that relies on correspondent banking and these pre-funded Nostro and Vostro accounts. It's highly secure and handles massive global volume, sure, but it can literally take days to settle a transaction. On the other side, we're seeing decentralized blockchain solutions like Ripple's XRP Ledger. Instead of hopping through correspondent banks, it uses a digital bridge asset to settle cross-border transactions on a distributed ledger in just 3 to 5 seconds.
But hey, traditional finance isn't just sitting still. They're actively bridging this gap through something called the ISO 2022 migration. Mandated for global completion around 2025 and 2026, this is a massive foundational shift from legacy Swift formats to a highly structured XML-based format. With 940 specific data fields, it drastically improves the data payload, dramatically enhances anti-money laundering screening, and significantly reduces the truncated data errors that usually cause cross-border payments to fail in the first place.
So as we wrap up this explainer, I really want to leave you with a thought that brings our entire journey full circle. We started all the way back in 3000 BCE with invisible social ledgers of debt, meticulously tracked on clay tablets. And today, well, we've returned to invisible ledgers, tracked digitally on distributed databases and massive stateless switches like UPI. The form has definitely changed, but the fundamental architecture of value remains exactly the same. It really makes you wonder, what actually is money anyway? Thanks so much for joining me on this deep dive. Keep questioning the world around you, and I'll catch you in the next explainer.